Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Here's the thing is that you've started 3 years ago. You seem like a very savvy investor. We've got to prepare for the good, just like we have to prepare for a potential downside or a potential lull. I mean, who knows exactly what's going to happen in the short term. What are some of the things that you are doing as you're acquiring properties to ensure that you're not overly leveraged potentially, or that you have staying power should something happen down the road?
So for me personally, what I think what we need to focus on in this market, especially with now rising, with potential rising interest rates and the inflation that we're seeing, I've been leaning more towards heavy cash flowing properties, and that's just for me. It's a hedge because the properties that I have acquired in the Hamilton market up till now, because we've had so much appreciation in the market, the cash flow on those properties is really pinched, right? I self-manage them, so it's not really an issue. But if I were to decide one day to push them off into a property manager, now we come into a point where it's like, am I breaking even on this property every year, or are we making like a very small amount where we have one upset, you know what I mean? Where it's like, so I self-manage those, so they're fine, but long term, I want to kind of release that load on myself. And so I've been gearing more towards heavy cash flowing properties. And so that was part of the reason I kind of made a transition from the Hamilton market to a larger market like Hamilton into a smaller market like Sudbury, where I was able to get much more cash flowing properties. Now, with that being said, we are closing on a property in Hamilton in a month or two that, by the time we're done, we're expecting to make between $1,500 and $1,900 a month in cash flow. So there are opportunities. You just have to know where to look, and they're much more far and few in between. But that's been my goal, has been looking for more cash flowing properties to kind of create a hedge for myself.
Yeah, I mean, I agree with you. I've been preaching cash flow since I probably started this podcast, and I'm sure people are sick of hearing about it, but this is why, right? It's not just to replace your income over time. It's not just so banks keep, your lenders keep lending. I mean, obviously that helps as well if you've got a good, DCR ratio.
Mm-hmm.
It's for being able to ride the wave, because let's just say there's a 20% drop or a 30% drop. Again, I don't think it's going to be super steep necessarily in the bottom thirds of where we're investing. It might hit, if anything, the more expensive homes first, and then by area, it's going to be very different. But the cash flow will be that staying power, right? So your tenants are still paying the same rent, if not more, every single year. And, more people are going to need to rent probably, because if lenders start tightening up, or people are starting to sell, I mean, where else are they going to go? So the rental market is always going to be very different from anyways, I can talk about Ontario, but I can't say for every single province. Sometimes it differs depending on if people are leaving town actually because they don't have jobs, but most of them will have to rent. And in Ontario, the rents don't go up and down like the house prices. If things do happen, and they will at some point, right? It's a market cycle.
Yeah.
Do you have that staying power? The renters are likely still going to pay, and the cash flow is going to, I think, determine those who were just speculating, buying those condos that are super expensive, not cash flowing, versus the ones that are able to sustain the market with the ups and the downs because of the cash flow. So you talked about you talked about $1,900 of cash flow. That sounds awesome. I'm assuming, and correct me if I'm wrong, but that sounds like a duplex or multifamily.
It's a triplex in Hamilton that we recently that we're in the process of closing on. It's a great deal, but obviously we're much more invested. I have partners on the deal, and we're much heavier because of the cash flow. We're much more invested in these, and as opposed to my other ones are almost perfect BRRRRs or whatnot. So there is a trade-off for getting cash flow in those high equity markets, and it usually comes in the form of actual like equity. Anyway, so yeah, that's the cash flow that I have on that place. But I've been gearing more towards a Sudbury market and stuff like that, for the smaller markets where cash flow is, I'm going to say easier to find. It's still difficult to find, but you have to know what you're looking for, right? And I think that comes with everything.
In these new markets, like Sudbury as an example, are you buying already cash flowing properties, or are you converting them? Are you buying current multifamily? Like, what is it that you're currently buying to make it work?
So I'm doing typical renovations to what I was doing in the Hamilton markets. So I'm doing a lot of the single family homes to duplexes, single family homes to triflexes, and stuff like that. And I'm able to find some really great cash flowing properties because of that. My strategy there, and similar to my strategy in the Hamilton market, is buying in really good areas. And so I lean towards looking at tenant first and then area. So where are the tenants that I want? Where are they migrating to? Where are the high quality tenants? Because like you said, like as much as it's nice to hedge your bets and have that cash flow, if you have tenant turnover every year because you're in a bad area, that doesn't help you either, right? And so I look for, if I have to take a small, like a less return, to know that I'm going to get high quality tenants, I'll do that every day than just going for pure cash flow or pure, let's say, market appreciation, like some markets that we have in Southern Ontario.
Yeah, absolutely. It's a balancing act, especially if you're going to self-manage. The one thing I think is more and more interesting these days is that as Ford removed the rent control, so anything that's new dwelling units, after November 15th of 2018, this is for Ontario, obviously it differs by province, but all the units that you're creating that are new are not subject to rent control. So even if there is a downturn, and everyone's, there's no inventory and the market rents are going crazy, you can raise the market rents on those units that were not existing dwelling units before. Unless, and again, they can always change and go back on these rules. But as of recording this podcast right now, I think that's a great asset. And it's also, I think, an opportunity to hedge against a potential downside, because you could still raise market rents if things, are like, even your interest rates are increasing on your mortgages, that kind of stuff. Like, there are things that you can do by creating these units that were not existing before. Any thoughts on that?
No, not specifically. A lot of the tenants that I have, I think partly because I do self-manage, and I'm not saying this is great advice to anyone. I don't know if this is proper advice to be giving to people. But I have a decent relationship with my tenants because of the areas that I invest, because of the types of renovations that I'm doing. I have, I would say, higher quality tenants: the doctors, the lawyers, the nurses, I don't know, I want to say like the police officers and whatnot, the people who are much more responsible. And so I have a really good relationship with my tenants as a whole. So I haven't had to raise any rents like that using the Rent Control Act, because we get on a personal level. And so it's fine from that perspective. Obviously, as soon as they're out, I have no problem raising rents to standard levels, but I'm pretty fair with them in terms of how I adjust rates over year.
Okay. All right, cool.
Yeah.
So you talked about we a few times. Who is we? So what kind of partners do you have as you're acquiring more properties? Who are you bringing in on these deals, and what's your role and what's their role?
I think I use the we as the royal we a lot, but I have brought on a few partners at the kind of the front part of investing and bringing on partners. It's been a lot more family stuff. However you want to take your view on that. I have a really good relationship with my family and stuff like that, so it's not an issue. It was more a matter of getting them on board and understanding what the process was. And then now I'm starting to branch out to more non-family related investment partners and whatnot. So that's been going really well. We're looking to scale really quickly with bringing on those people as I go forward in the next kind of year and a half or so.
Okay, cool. And I know we had this conversation beforehand, right? Here's my take on it is I've done it twice, worked with family in some capacity, one as a tenant, one as a partner. Personally, and you might have a very different family than me, but personally, It's always turned out to be a bad choice for me personally, but I'm glad that so far it seems to be working out for you.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?